Hello guys, think about your last trade for a moment. Maybe you studied the chart carefully, the setup looked perfect, the level looked strong, and everything suggested the market would move in your direction. But right after you entered the trade, the market suddenly moved the other way. If you have experienced this, you are not alone. Many traders face the same situation. So let me ask you something, dear viewers. Is the market really random? Or is there a deeper logic behind these price movements? Professional traders often believe that markets move based on liquidity, and behind that liquidity are large participants, commonly known as market makers. In today's discussion, we are going to explore this idea together. We will talk about who market makers really are, how these large institutions make money, why the market often moves against the majority of traders, and by the end of this video you may start looking at charts in a completely different way. Before we go deeper, let me say something important to everyone watching. This video is created for educational purpose only. It is not financial or investment advice. Always do your own research and use proper risk management before making any trading or investment decision. Now that's we made that clear, let's start understanding how the market actually works. First, let's answer a simple question. Who exactly are market makers? Many people imagine a mysterious person controlling the market from behind the scenes, but the reality is more practical than that. Market makers are usually large financial institutions. These can include major banks, hedge funds, liquidity providers, large institutional trading firms. Their main job is to provide liquidity in the market. Liquidity simply means that there must always be someone ready to buy and someone ready to sell. For example, if you want to buy an asset, someone must be willing to sell it. Without enough liquidity, trading would become slow and inefficient. Market makers help users that trading continues smoothly. But let's be honest about one thing, these institutions are not doing this out of generosity. Their goal is to make profit while handling huge flows of buy and sell orders coming from traders around the world. Now, many beginner traders believe that market makers simply move prices wherever they want, but in reality, their profit comes from several structured mechanisms. Let's look at three of the most important ones. The spread. The first source of income is something called the spread. The spread is small difference between the buying price and the selling price of an asset. And the next one is order flow. The second mechanism is order flow. Every second, the market receives a massive number of buy and sell orders from traders across the world. Market makers help manage and process those orders by balancing supply and demand and facilitating transaction between buyers and sellers. They can generate consistent revenue while keeping the market active. And the third one is concept is that traders often talk about is liquidity hunting. Large institutions cannot easily place very large orders anywhere in the market. Doing so could move the price too aggressively. Instead, they prefer areas where many orders already exist, and their viewers, those areas are usually very obvious level that most traders watch. For example, support and resistance level, stop loss clusters, breakout zones, and psychological price levels. When price approaches these levels, the number of orders in the market increases significantly. This creates the liquidity that large players need to execute their positions efficiently. Now let's talk about something many traders find frustrating. Sometimes the market moves in the opposite direction of what most traders expect. Why does this happen? One important reason is that retail traders often place their trades in very similar locations. Let's imagine a simple situation. Price reaches a strong resistance level. Many traders see that resistance and decide to open sell positions. At the same time, most of them place their stop losses just above the resistance. Now something interesting happens. Above that resistance level, there is a cluster of stop orders waiting. From a liquidity perspective, this area becomes very attractive. If the price moves slightly higher and triggers those stop losses, a large amount of buyers orders suddenly enters the market. That surge of liquidity allows large participants to open bigger positions. This is why the market sometimes breaks a level briefly before reversing direction. And now we will discuss the liquidity concept. Professional traders often look at the market through the lens of liquidity rather than relying only on indicators. Instead of asking only where to enter a trade, they ask a different question. They ask, where is liquidity likely sitting? Price often moves from one liquidity zone to another. Some common liquidity zones include equal highs and equal lows, previous daily highs and lows, trend line break areas, consolidation ranges where price moves sideways. When price approaches these zones, market activity often increases. Understanding these areas can help traders anticipate where price may move next. And the next amazing point, it is important to realistic. No single bank or institution control the entire financial market. Financial market are extremely large and involve many different participants. Price movement happen because of complex interaction between institutional traders, retail traders, algorithmic trading systems, global economic events, and news. So the goal of learning about market makers is not to assume manipulation everywhere. The real goal is to understand how liquidity influences price movement. Now, the question many viewers might be thinking is, how can traders actually use this knowledge? Here are three practical ideas. Avoid very obvious entries. If a trade looks extremely obvious to everyone, there is a chance that many traders are entering at the same place. Sometimes the market moves slightly beyond that level first before choosing its real direction. And the next one is look for liquidity zones. Start paying attention to areas where traders are likely placing stop losses. These zones often attract price movement because they contain clusters of orders. Even the best analysis cannot remove uncertainty from trading. Markets can always behave unpredictably. Successful traders focus on managing risk and protecting their capital rather than trying to predict every market move. The next time you open a chart, try to look at differently. Instead of asking yourself only where should I buy or where should I sell, ask a deeper question: where is the liquidity likely sitting? Because very often the market moves toward those areas, and when you begin thinking this way, dear viewers, you slowly start to analyze the market more like experienced traders do. If today's discussion gave you a new perspective on how market behave, consider following my YouTube channel for more educational content about trading crypto and financial markets, and feel free to share this video with other traders who are trying to understand how price movement really works. Thanks for watching. I will see you in the next video. Take care.